Brexit was sold as a path to freedom, but in 2025, Britain is paying the bill. And the costs are shocking. From food prices to investment collapse, here are 5 economic realities no one in Westminster wants to admit. Number 1. A strong start doesn't mean a strong finish. It's not every day you get to prove the Bank of England wrong, but that's exactly what happened when Britain showed a surprising GDP growth spurt in the first fiscal quarter of 2025. At 0.7%, modest and worth appreciation, the United Kingdom actually did better than the 0.6% that leading economists and the Bank of England had forecasted. The UK managed to break the dry spell from the last 3 quarters of 2024, where growth remained stagnant at 0.1%. Obviously, the Finance Minister Rachel Reeves took a moment to celebrate the win. She'd been under fire since announcing social security increases and claimed that the spurt just meant things were looking up, especially since the UK had been navigating a post-Brexit world filled with trade wars, tariffs, and the rising cost of living. She said, "In the first 3 months of the year, the UK economy has grown faster than the US, Canada, France, Italy, and Germany." But Reeves might have celebrated a little too early. The only reason why economists miscalculated the UK's GDP growth rate was that they didn't know when Trump tariffs would take effect. For context, the US president introduced what he calls reciprocal tariffs. Basically, America plans on taxing goods coming from other countries in a manner reciprocal to what they either are or have taxed US goods. This puts most British goods at risk, especially steel and aluminium products at a high risk. The spurt we're talking about isn't the UK's economy stabilising after a long time. No, it's actually British companies rushing before Trump's tariffs take effect. According to Reuters, this is as good as it's going to get in 2025, with a 1% expansion overall, but nothing to write home about. Reeves' victory isn't a newly strengthened economy, it's just that British companies are panicking. By the second quarter, growth slowed sharply to 0.3%, with the Office for National Statistics noting that services and construction barely kept things afloat while manufacturing contracted. When you look at year-on-year numbers, GDP is up 1.2%. Breaking that down by sector, services ticked up 0.4% and construction was surprisingly strong at 1.2%. But the production side dragged, falling at 0.3% overall. Within production, electricity, gas, and related utilities took a big hit, though manufacturing had a mild positive contribution. Both the OECD and the IMF have been pretty blunt. This isn't the win you think it is. The OECD is penciling in just 1.3% growth in 2025, dropping to 1% in 2026, while the IMF is slightly less gloomy, but still warns that the UK will struggle to clear 1.2% this year. The reasoning? Inflation just won't quit, weak business investment, and consumers who are still feeling the pinch. The UK is still wrestling with higher import costs, more paperwork at the borders, and slower trade for the EU. For businesses, exports are more expensive, and foreign investors don't see the UK as the easy gateway to Europe it once was. The IMF even pointed out that business investment is still abysmal, a hangover from the uncertainty that started way back in 2016. Number 2. You cannot wish away inflation. What drives an economy? Spending money. And when do you spend money? When you really have to. And when would you spend a lot of money? When something's really expensive. Inflation has earned a bad reputation, even though in theory it's supposed to drive the economy and keep money flowing. But like every other concept in economics, it gets trickier the more you get into it. See, inflation could have been a great thing if it were driven by people making more money today than they did before. That way, you're only spending more money in theory because things are expensive, but you make more money and it's all adjusted like that. Call it the new normal. What isn't supposed to be the new normal, though, is how you no longer have the money or resources to buy things that have continued to get more and more expensive. Do you know what that's called? A cost of living crisis. And yes, the United Kingdom is going through one right now. In the 2024 autumn budget, Reeves announced that from 6th of April 2025, the employer national insurance contributions rate would rise from 13.8% to 15%. At the same time, the secondary threshold, that's the minimum earnings level at which employer NICs kick in, would fall from £9,100 to £5,000 per year. That doesn't sound right. It sounds like someone drafted it up without really looking it over, not even typos, and everyone's wishing there are a couple of them there. But Reeves assured everyone this was happening, and it was happening for a reason. This combination of a higher rate and lower threshold was projected to generate £25 billion annually in additional revenue over the forecast period. But according to the OECD, the UK is projected to have the highest inflation among G7 nations in 2025. According to the OECD, inflation in the UK will average 3.5% in 2025. The figure is well above even that of the US at 2.7%, despite Trump imposing the biggest tariff since the 1930s on imports. The OECD said UK inflation would slow to 2.7% next year, still well above the Bank of England's 2% target. When you layer Brexit into the mix, it becomes even trickier. Leaving the EU didn't just redraw trade lines, but introduced extra friction in supply chains, new custom costs, and regulatory divergence. All of this has added to import costs and squeezed margins. Inflation isn't rooted in global forces, it's actually a structural drag that the UK has to deal with. Simply, inflation isn't a temporary storm you can ride out. It's more like a low-pressure system sparked over the country, fueled by energy, food, labor, and trade costs. The OECD also noted that trade wars, such as tariff pressures from the US, are feeding into global inflation, and the UK's feeling it deeply. Hopeful optimism might have been the UK's biggest mistake in this case. Productivity has been weak for years, and forecasts repeatedly underestimate the scale of the headwinds. Rising costs for groceries, energy, rent, and transport are emptying bank accounts. And if wage increases lag behind, this just goes on and on. The Bank of England has already signalled that inflation will go up further, with an expected peak of around 3.5% in Q3 2025. Number 3. Too expensive to be British anymore. Everyone goes through hard times. There are days when you have to buy off-brand detergent because it's just one of those days, right? Well, it's not just one lousy paycheck after another anymore. It's more like the collective complaining of how it's gotten increasingly difficult to afford even the bare essentials. That, everyone, is called the cost of living crisis. Basically, it's when everything's gotten so expensive that you can't even afford to live anymore. Of course, living, in this case, is assessed through the basic parameters. Do you have a roof over your head? Do you have food? And so on. Since late 2021, the prices of essentials like food, energy, and housing have been climbing faster than most people's paychecks in the United Kingdom. You've probably seen headlines about awful April or steep water and energy bill hikes. In that month, water and sewage bills jumped by over 26%, the fastest rise in decades. It's no surprise households are cutting back on non-essentials, rationing heating, and sometimes skipping meals. And did you know Brexit alone added nearly £6 billion to UK food bills in 2 years? Right now, only a third of Britons would describe themselves as comfortable financially. This was according to a poll published by YouGov. 56% say they've already been hit by cost of living pressures, enough to make cuts to what they usually spend. Another 21% are still keeping pace, for now, but expect they'll need to cut back soon enough. That leaves just 19% who say they've been able to maintain their usual spending and expect to carry on doing so. There's also widespread frustration with the government. 81% of respondents say they're handling the cost of living badly, and looking ahead, the mood is bleak. 53% of people expect the UK will be in recession by 2026. Lesson 4. Investors need to trust a business before investing, and they don't trust British businesses anymore. In every other context, you'll have to lose some to win some, right? But that doesn't apply to profit sales and investments. In these cases, investors want to win big, and they're not looking to lose anything at all. While investments are always at risk, they're extremely well thought out and calculated. Imagine a boardroom of investors coming together over a crystal ball and thinking of every possible thing that could go wrong. If at any point they feel like it's too big a risk, they simply pull out, and right now the United Kingdom as a whole is just too risky to invest in. Firms are clearly spooked by rising costs, looming tax burdens, and regulatory unpredictability, and that sentiment is echoed by rising employment costs and energy bills that have dragged confidence down to record lows. Take the Institute of Directors' latest survey. Business morale just hit an all-time low, with their confidence index plunging to -74, the weakest reading since they started in 2016. That's not a small dip, that's a crash. On one hand, 83% of business leaders say they feel confident about their firm's own prospects over the next year. On the other hand, they're much more cautious about the UK's economy as a whole. 57% expect a recession within 12 months. Why the split? Well, because people trust their own micro decisions more than they trust macro policy. An investor looks at a British firm and wonders, will the government raise taxes after I commit capital? Will new trade rules make my exports uncompetitive next year? There's already evidence that this mistrust is holding back investment. A rising share of business leaders flag higher taxes as a primary threat. In 2025, taxation concerns overtook energy as a top worry in BCG's survey. The LOD pointed to fears over future employment rules and business taxation as major drains on morale. Add that to structural uncertainty. With Brexit, the UK no longer had the same seamless access to EU markets. Many multinational firms have openly told BCG they believe the UK is becoming a less attractive place to invest in compared to other markets. So when a British business pitches expansion, investors are pricing in political risk, export penalties, and regulatory shifts. You can have good ideas in the UK, but without trust and predictability, even the best plans will stay on paper. Yes, you need investors to believe in your business and feel safe that the rules won't change after they put in their money. But in 2025, after years of Brexit shockwaves, tax rises, and policy whiplash, many investors just don't trust British businesses as much as they once did. And that's a confidence gap that's costing the UK. Number 5. Britain's structural weaknesses are no longer hidden. The cracks in the UK's decade-long policy drift since exiting the European Union are no longer under the surface. They're glaringly obvious now. You see, there was a time when you could mask structural weaknesses with strong commodity prices and global tailwinds. Well, this isn't the case anymore. Take productivity, for instance. The Office for Budget Responsibility estimates that about 1/3 of the lower-than-expected growth this year is down to structural weakness, especially weak productivity. The UK just isn't getting more output per hour the way it needs to, and part of that productivity gap reflects decisions made since 2016. Lower investment, trade frictions, and reduced labour mobility. Customs costs, rules of origin, and regulatory complexity, and this has distorted investment decision. Some firms never committed to scaling precisely because of Brexit uncertainty. Not every corner of Britain is equally wounded, but the gap between winning and lagging regions is huge. EY's regional forecast suggests most UK regions will see annual growth of 1.3% to 1.7% in 2025 to 2028. Not exactly generous by historical standards, and the problem is worse in the northeast, where employment growth is forecast as nearly flat. You'll see unfilled tech vacancies, skilled labor shortage in manufacturing and digital sectors, but also large pools of underutilized labor outside prime regions. Some regions can't attract the talent they need, others can't upgrade because local supply chains and infrastructure are too weak. Regions with poor digital networks, weak transport links, or energy constraints never had a fair shot. EY flagged that infrastructure investment, particularly broadband, energy grids, and transport, is uneven across the UK. Without bridging those gaps, many places will stay stuck in low-growth limbo. Unless the UK tackles these head-on with bold reforms, it risks being locked into stagnation, while rivals move forward, leaving its economy increasingly fragile. When you look at Britain in 2025, it feels like a country that's going through a rough patch, and more like one that's stuck in a self-destructive cycle. That bursts of growth early in 2025 didn't last long. Prices are still climbing, and everyday life just feels harder to afford. Businesses and investors are scared. They're unsure if the rules and laws will change again, while deeper problems are staring us in the face. For years, we could hide these cracks behind optimism or global tailwinds. Not anymore. So the real question is, will Britain finally fix the cracks Brexit left behind, or are we just going to keep limping behind?